Welcome to the Bullion Signal Podcast, the channel where we cut through the noise to focus on the signals that truly matter for your wealth in these chaotic times. If you're here to understand the macro trends shaping our world, especially when it comes to gold and silver, go ahead and hit that subscribe button. You won't want to miss what's coming. For what feels like an eternity, silver has been, it's been the forgotten metal, living in gold's shadow. But suddenly, that's all changed. It's like a sleeping giant has awoken, and the price action we've seen has been nothing short of breathtaking.
And of course, that's the first question on everyone's mind. You see a chart that's gone practically vertical, and your first instinct is to think, wow, I missed it. The run is over. It's too late to get in. It's a totally natural reaction. We're all wired to be wary of chasing a price spike. But today, I want to show you why asking, is it too late, might be the completely wrong question to ask about silver right now. I want you to consider a different frame for this, a totally different possibility. What if this recent explosion in price isn't the final firework of a bubble about to pop? What if it's the first major tremor before the earthquake? We might be witnessing the very beginning of a fundamental, once-in-a-generation repricing. And this repricing isn't being driven by hype or speculation on Wall Street. No. It's being forced by a simple, undeniable, and frankly brutal physical reality that can no longer be swept under the rug. The physical market is finally taking the wheel.
Okay, so to really grasp why this is happening now and with such force, we have to dig down to the root of the crisis. This isn't some flash in the pan. This situation has been building quietly, methodically, for the better part of a decade. And the absolute core of the story, the engine behind this whole move, is a massive and chronic supply deficit that has been silently draining the world's silver inventories completely dry.
Just let this number sink in for a moment. 7. For 7 straight years, without a single break, the world has consumed more physical silver than every single mine on the planet has been able to produce. This isn't a one-off event or some statistical blip. It is a deep, structural, chronic condition, and it's getting worse, not better, every single year.
So the logical question is, if we're using more than we're mining, where is all that extra silver coming from? Well, it's been pulled from the world's savings account, from the above-ground stockpiles, the vaults in London and New York that are supposed to back the entire market. And the amount that we've had to withdraw, it's just mind-boggling. Since this deficit started back in 2019, the world has been forced to pull 1.1 billion ounces of silver out of these inventories, just to keep the system functioning.
1.1 billion is such a big number, it's hard to really get your head around it. So let's put it in perspective. The entire planet mines, on a good year, maybe 820 million ounces of silver. That means we have already burned through more than a full year of global mining production. That silver is gone. It's vanished. It's not coming back. We have literally been borrowing from our future supply to satisfy today's demand, and the bill for that borrowing is finally coming due.
And when you look at where exactly this silver is disappearing from, the picture gets even more alarming. Yeah, overall stockpiles are down about 15%, which is a huge deal on its own. But the real 5-alarm fire, the number that should keep you up at night, is the COMEX eligible inventory. That's the silver that's supposed to be available to deliver against futures contracts, the very foundation of the paper price, and it has plunged by a staggering 40%. The warehouses that give the paper market its credibility are being emptied at a ferocious pace. And this really brings us to the most critical point of all. The buffer is gone. That big pile of inventory that has masked this deficit for 7 long years is now running on fumes. And here's the kicker. You can't just wish more silver into existence. You can't just flip a switch. Bringing a new major mine online is a monumental undertaking. It takes on average 5 to 10 years of exploration, permitting, and construction. There is no quick fix here. There is no cavalry coming over the hill to save the day. We are right at the edge of a physical tipping point.
So, we've established the supply side is in crisis, but what's on the other side of the equation? What is this relentless force that's causing this structural deficit? What's consuming every single ounce of silver it can possibly find? Well, the answer is a tidal wave of industrial demand that is acting like a black hole, pulling physical silver out of the market and consuming it permanently. You know, for generations, most people thought of silver as just money or something you make jewelry out of. Let me be clear, that idea is now dangerously out of date. Today, industrial applications make up a massive 55% of all silver demand. It's not just a precious metal anymore. It is the absolute lifeblood of our modern, high-tech global economy. It's a strategic commodity that we literally cannot function without. And this isn't some static demand. It is exploding higher, and it's being propelled by the biggest global megatrends in modern history. Let's start with the green energy revolution. Solar panels alone are on a trajectory to consume nearly 1/3 of all the silver that is mined in the entire world this year. Think about that. 1/3 for just one application. And then you add in the electrification of everything else. Every single electric vehicle, every 5G cell tower, every new AI data center that comes online, they all require huge amounts of silver. This demand isn't optional, it's non-negotiable, and it is growing exponentially. So what you have here is this incredibly imbalanced, almost violent collision of forces. On one side, you have demand that is being shot to the moon, backed by trillions of dollars in global investment and government mandates for green energy and AI. And on the other side, you have supply. And supply has been basically flat, stagnant for over a decade. Why? Because years of low prices destroyed any incentive for mining companies to go out and find and build new mines. You simply cannot undo a decade of underinvestment in the span of a year or two. It's impossible.
The best analogy I've heard is this. It's like you're trying to fill a massive swimming pool using a tiny little garden hose. But at the same time, on the other end of the pool, there are two giant industrial pumps draining it dry. And the most important part of this analogy is that the water being pumped out is gone forever. That industrial silver gets locked into tiny components inside solar panels and EVs and iPhones. It's consumed. It is never coming back to the market. It is permanently removed from the available supply every single day.
Okay, so we've got inventories that are vanishing and an industrial demand that is absolutely exploding. The natural question is, what happens next? Well, the good news is we don't really have to guess. History actually provides a remarkably clear roadmap for what happens when a physical commodity shortage slams into a period of major monetary instability. And the macroeconomic setup we find ourselves in right now is an almost perfect echo of the 1970s.
Just look at the parallels. In the 1970s, you had the end of the gold standard, which unleashed rampant, crippling inflation. People lost faith in paper currencies and they fled to hard assets. Silver surged by 700%. Now, fast forward to today, what do we have? We have a global move away from the dollar, known as de-dollarization. We have persistent, sticky inflation that central banks can't control. And we have this massive green tech and AI industrial revolution. The parallels are just too strong to ignore. As the saying goes, history may not repeat, but it certainly does rhyme. And right now, it's practically shouting at us. When you put all of these factors together, the historic deficit, the insatiable industrial demand, the chilling historical parallels, they all point towards one inevitable conclusion. I like to call it the Great Price Divorce. This is the moment when the price of a real, physical ounce of silver that you can actually hold in your hand violently separates from the price of a paper promise for silver, like a futures contract. The physical reality of the market is about to completely overwhelm the paper fiction. And one of the most reliable tools we have for seeing this divorce coming is a very simple metric known as the gold to silver ratio. It's exactly what it sounds like. How many ounces of silver does it take to buy 1 single ounce of gold?
For hundreds, even thousands of years, this ratio has acted as a powerful yardstick for the relative value between these two monetary metals.
And I want you to look at the massive disconnect here. Today, that ratio is sitting around 73 to 1, but the long-term historical average is way down around 40 to 1. And for centuries, going back to ancient times, it was often fixed by governments at around 15 to 1. So a ratio of 73 is a massive historical anomaly. It's a flashing red light on the dashboard, screaming that silver is profoundly, fundamentally undervalued relative to gold. And that's before you even factor in its indispensable role in modern industry, which gold just doesn't have.
So let's just walk through the logic step by step, because it's actually very simple. Step 1. 7 consecutive years of deficits have drained the vaults. The buffer that kept the price suppressed is gone. Step 2. An unstoppable wave of industrial demand is consuming every ounce it can find, and this demand is permanent and structural. And Step 3. Both historical parallels in key valuation metrics like the gold-silver ratio are all signaling that a major historic repricing isn't just a possibility. At this point, it's a mathematical inevitability.
So where do we go from here? The price simply has to rise. There is no other release valve for this pressure. The price must go high enough to do one of two things: either destroy industrial demand, which is highly unlikely given the trillions committed to the green transition, or it has to go high enough to finally incentivize the colossal investment needed to bring new mines online. In the short term, that math points towards a price of around $85. By mid-2026, many analysts who focus purely on these physical fundamentals are looking at a range between $100 and $200 per ounce. And please, do not expect this to be a slow, orderly climb. As the legendary silver analyst David Morgan has warned for years, we are now entering what he calls the explosive phase of this bull market. That's the part where 90% of the total gains happen in the final 10% of the time. This is what happens when a physical squeeze takes hold. It's not a gentle rise, it's a panic, as every industrial user and investor realizes the shelves are bare and they all rush for the exit at the same time. So I'm going to leave you with one final question to think about. When an undeniable, irrefutable physical reality, the reality of a 7-year supply deficit and empty vaults, collides head-on with a paper market that's built on the promise of delivering metal that may no longer exist, which one do you think is going to break first? The paper promise or physical reality? The answer to that question will likely determine the future of your wealth in the years to come. Thank you for tuning into the Bullion Signal Podcast. If you found this analysis valuable, please do us a favor and hit that like button and share it with someone who needs to hear this message. And of course, subscribe so you don't miss our next deep dive. Just a quick reminder, this content is for informational and educational purposes only. It is not financial or investment advice. You should always conduct your own research and consult with a professional before making any financial decisions. Stay safe and stay informed.